Good evening. I'm Destiny Coleman, the Administrative Director of the Woltamati Center for Economics, Business, and Entrepreneurship, and I'd like to welcome you all to the Economic Outlook Conference. This evening's event is sponsored by both the Economics and Business Department and the Woltamati Center. Inspired by the work of late Dr. Uwe Woltamati, Professor of Economics at Ohio Wesleyan University from 1965 to 1995, the Woltamati Center was established in 1985. Grants and gifts from the Cleveland Foundation, the Ford Motor Company Fund, alumni and friends provided the startup funds for the center. Since its founding, the center has received support from foundations, individuals, alumni, and corporate sponsors. The Woltamati Center is a major resource connecting the university with the business community. Its mission is to enhance academic programs and provide real-world opportunities to create future business and world leaders. I would now like to welcome Matt Bullrath, Faculty Director of the Woltamati Center and Professor of Business Administration.
Hey everyone. Thanks so much for being here tonight. We are really excited to be hosting this once again. 2019 was the last time we had the Economic Outlook Conference, and then things kind of got put on hold for a while. So this is a long-running event, and you all get to be here for the reincarnation. Like Destiny said, I'm faculty director for the Woltamati Center, and the center's role here on campus is to create opportunities like this, where there are things happening outside the classroom that enrich your experience, students, where you're getting to meet people who are doing things in your field, being connected with just experiences that you wouldn't have when you're just in the classroom setting. So thrilled that you get to be here tonight, and I'll introduce now Dr. Goran Skosples, who is the chair of the Department of Economics and Business, professor of economics, and he will be the moderator this evening.
Hello everyone, and so good to see you. And have this after 3 years. I always look forward to this event. It is one of my favorite events of the year. So I'm going to be the moderator. I won't speak much. I won't give perspective. That's why we have our distinguished guests. But let me introduce our distinguished guests to you. So I'll introduce them in the order they will present. Now, we are doing a local, a national, and an international outlook. So each of our presenters focuses on one of these areas. Obviously, there's lots of crossover, but in general, they're specialized in either local, national, or international. So Ian Sheldon holds a chair in agriculture, marketing, and policy at Ohio State. But given that he's an international economist, you might wonder, how relevant is his research to Ohio corn, wheat, and soybean farmers? Well, this past year has shown us that we may stay in Ohio and not travel much or so far as China or Ethiopia, but doesn't mean that our products are not going there. Our farmers get affected by the global events. I'm particularly thrilled to get Ian's perspective on the tsunami of global shocks that we are currently in the midst of, and given that he is from England, to get a little bit of perspective of what's going on, all the mess that's going on over there in England. The second presenter will give a national outlook, and that'll be given by Mark Schweitzer. So the national outlook will be provided by Mark, whose presentations have always been very informative and inspired many conversations in our classrooms past economic outlook conferences. So after a time of relatively boring monetary policy, I teach macro, and lots of times it's a little boring to teach, nothing going on. What do we have now? It's quite busy. We have lowering interest rates during the pandemic, now raising interest rates. Inflation is too low, inflation is too high. Mark's presentations have been very informative, and I'm certain Mark will present the complex national situation in a way that we can all understand without having a PhD in economics degree. The last presenter is Bill LaFayette, and he's going to give us the local perspective. So understanding the local economy is critical for economic developers, business owners, workforce professionals, and local officials alike. And Bill critically understands the relationship between economic development in the Central Ohio region, workforce development, and knows that neither can succeed without the other. He He's the authority on the Central Ohio economy. I have not heard a single economic news regarding Central Ohio where Bill's view was not included. Just this morning, there was a report on the Marion development or economic development program, and of course, who was quoted? Bill. So it's glad to have him, a local celebrity. So I'm looking forward to all three aspects of the economy, and without further delay, let's get the party started. Ian?
Thanks very much, Goran. It's great to be back. I said earlier over dinner, the last time I presented here, I think it was Bill and Mark and myself on the program. So we got the old band back together again, and the T-shirts are for sale outside afterwards. And actually, this is the first public Outlook talk, other than the hybrid webinars that I've given over the past, going on for nearly 3 years now. First public one since I think the last one I gave was at the Lima County Fairground in an ice storm in February of 2020. So that's the last one that I did publicly, and there were about 15 people there. So it's great to see so many faces here tonight. You know, I think probably over the many times that I've been up here to talk, I think every time we've talked about the unprecedented times we live in. And, you know, we've been through, I as an economist have been through the financial crisis, followed by the period of high unemployment and slow growth. Then we went into the trade war with China, which is, you know, Goran was saying life was really boring for a monetary economist when interest rates are really low. Well, as a trade economist, I spent most of my career talking about trade wars, and there never was a trade war. And whilst I don't wish to thank the previous administration for a trade war, it certainly kept me busy as an economist. Then we moved into the pandemic, and now, of course, we have the invasion of Ukraine by Russia and all the other global macroeconomic issues that we're faced with, and that's what I'm going to talk about this evening. See if I can find the right button here. We're up and there we go. So what are the key features of the global economic outlook that I'm going to talk about tonight? Well, inflation is at a multi-decade high. Obviously, Mark is going to talk about the US situation in particular, but this is common to both developed economies like the United States, the European Union, and of course my home country, the United Kingdom, and more about the UK shortly. And in emerging economies as well. And I can show you some data of what the forecasts are for developed, the world, and emerging economies when we look at GDP growth and the outlook for inflation. And what we're observing, and Mark no doubt will talk about this in more detail, is that this is, we're witnessing very tight monetary policy that goes with this unusual inflation that we're having for decades since we've had inflation. And as well as that, we're seeing declining fiscal support. By that I mean declining levels of public spending. And of course, Britain is going through this whole mess about how do we finance unfunded tax cuts. Secondly, and this is what I've spent most of my time talking about publicly, mostly through TV and radio interviews, is, in fact, somebody called me the day Russia invaded Ukraine on February the 24th this year. The ongoing war in Ukraine is obviously very disruptive politically, and it's been found to be extraordinarily disruptive economically, and as Goran suggested, as an agricultural economist, this has been very important when you consider that Russia and Ukraine, between them, account for something like 30% of the world's grain exports. So they're very important to global grain markets, and I'll talk a little bit about that later on. Thirdly, despite the moderation, I mean, we're all sitting here tonight, we're pretty much all unmasked, and we're all vaccinated, and we don't seem to worry about this as much as we did. But the pandemic is still affecting economic activity, particularly through supply chain issues are still important, and this is particularly the case with China. I was telling my colleagues earlier that I have a colleague in my department who's currently stuck in China. He went back to take care of his aged parents back in the summer, and he's stuck in quarantine somewhere in Wuhan, unfortunately. And finally, on the ag production side, not only have we had the invasion of Ukraine by Russia, which has affected commodity markets, but We've had significant weather shocks over the past year, particularly drought in Europe, the worst drought basically in recorded history, particularly affecting corn prices, droughts in India affecting particularly wheat, and we've got very dry conditions out here if you go further west from us out into Kansas. And if any of you are following this, it's very hard to run grain barges down the Mississippi River right now because the river levels are so low, and this is pushing up transport costs quite significantly for my farming colleagues. And this slowing down of the global economy is pretty much driven by a bunch of downside risks that I'm going to talk about later. So here's the forecast. I'm not going to take credit for this. You can blame the International Monetary Fund. This is not my job to do economic forecasting. I go typically with the most complete one that I can get in October. The IMF put out an economic outlook in twice a year, in October and April. So looking at global growth, in 2021 it was 6%. It's forecast to decline to 2.7% in 2023. As a benchmark, global economic growth has averaged 3.6% over the last 2 decades, of course largely driven by countries like China and India and other economies in the Pacific Asia region. In terms of advanced economies, economic growth is projected to slow down from 5.2%, that was us coming out of the pandemic. In emerging economies, forecast to be down to about 1.1% in 2023, so a significant slowdown in economic growth. On the emerging economy, developing economy front, these economies are also slowing from a growth rate of 6.6% this year, or last year, I should say, to 3.7% in 2023. In terms of global inflation, I guess this is if you want to see this as a half glass full as opposed to a half glass empty forecast, then inflation is expected to peak this year at 8.8% globally and is expected to fall to about 4.1% in 2024. But most of the upward inflation revisions that we've seen, particularly from the IMF, because the IMF got it extraordinarily wrong, I think, about a year ago, is that most of these inflation revisions are for advanced economies such as the United States and the European Union. So here, these are straight out of the IMF. You can get their data in a very nice Excel spreadsheet. So on the left-hand side, you have the GDP growth rates and the forecasts. The blue line is the world, the green line are the advanced economies, and the red line are the emerging economies. And you can see the expectation is that we're seeing a slowdown in economic growth across the board through 2023, and then a modest pickup in 2024, with the emerging economies growing faster than the rest of the world, which is what you probably would expect. Then the upside of the forecast is you can see that inflation is expected to peak this year around the world and then is supposed to tail off in 2023 through into 2024. So what are the factors affecting the outlook? Well, I think, as I just suggested, and the forecasters got it wrong, or many of them did, inflation has risen a lot faster around the world and much more persistently than it was expected to increase. And central banks, and Mark will talk about what the Federal Reserve has been doing, but central banks around the world, including the European Central Bank, the Bank of England, banks in emerging economies, have all been very rapidly lifting their nominal rates of interest. This is the major lever we have to affect inflation, especially if you operate in an economy that's focused on inflation targeting, as I guess the Fed has returned to inflation targeting since over the past couple of years. The war in the Ukraine is having a very significant impact on natural gas exports to the European Union. Countries like Germany are very dependent on imports of natural gas. With the war, this is either close to shutting down supplies or significantly restricted supplies, and this has really affected inflation in countries like the United Kingdom, and that's because we don't import gas from Russia, but gas is priced off the world price, and the restrictions on Russian exports have affected world prices of natural gas, and then this just feeds into all the different economies, particularly in Northern Europe, where they're very dependent on these gas supplies. Despite the agreement, if you follow these things, late August, Turkey and the United Nations managed to broker an agreement involving the Ukraine and Russia to open up the ports on 3 ports on the Black Sea, including Odessa, because Russia had basically blockaded all 17 ports on the Black Sea, which is the major exit point for grains out of both Ukraine and Russia. And just look at the geography. You go out of the Black Sea, you go through the Bosphorus, through past Istanbul, down and out into the Mediterranean if you want to go to North Africa, or down through the Suez Canal if you want to go to the Horn of Africa and other parts of the Middle East. These countries were very reliant on getting particularly wheat and corn, and the Europeans are particularly reliant on getting sunflower oil and sunflower seeds out of Ukraine. Ukraine accounts for like 75% of global trade in sunflower oil. So despite that agreement, which has eased prices in the grain markets, global food prices still remain quite high, and they're also quite volatile, and I'll give you an example of that volatility. And then the pandemic is still affecting the global economic outlook, especially in China, and I'll mention briefly there's shutdowns and quarantines in Shanghai. I just mentioned my colleague who's locked up. He went to China to look after his parents back in July, and he hasn't been back yet. Unfortunately, he's not teaching this semester. So here's a few graphics. I don't know how well they show up. What you can essentially see here is that around about 2021, inflation really started to pick up. And the blue line is showing you the mean level of inflation. The red line is showing you the median level of inflation. And then you can't see it very well, but there's like a gray shaded area around the mean and the median that show you the 25th, the 25th, and the 75th percentiles. But what you can see is this rapid increase in core inflation. And this is a sample that includes, I can read you a few of these: Argentina, Brazil, Canada, China, Colombia, Czech Republic, Germany, et cetera, et cetera. There's a whole bunch of countries that are in that index of inflation. Here's, again, these graphs aren't showing up particularly clearly. This is change globally in monetary policy. And if you look at this carefully, you'll see that up to about mid of 2021, most economies had pretty soft monetary policy around the world. And then you see monetary policy, this rapid increase in increasing interest rates really kicking in both emerging economies and advanced economies. So this is common across the board, this rapid tightening of monetary policy around the world. This is not something that's unique to the United States. This graphic's pretty clear. This is a million metric tons per day of natural gas being exported out of Russia. And I'm just going to walk over to the slide because it's easier to show it. If we go back to February 2022, this is when Russia invaded Ukraine. You can see the gas supplies were okay up until the summer, and then you just start to see the taps getting shut off. And the red one is the Nord Stream gas pipeline, and we're talking about a significant reduction in natural gas supplies. So we're talking about, for example, in my home country, home heating costs have doubled already, and they're expected to double again in the next 12 months. So not surprisingly, the British government is really worried about this in terms of social instability. Then we still have rising food prices. On the left-hand side, this is an index. So this is again from the IMF and published by the United Nations Food and Agricultural Organization. Here you can see as we come out of agricultural trade was pretty robust during the pandemic. So as we start to come out of the pandemic, we start to see this significant increase in food prices. And we've pushed up food prices to where they were in the 2008-2010 food price spike that we had, particularly in prices of rice, corn, and wheat. And then on the other side, you'll see that correlated with that, and this is what the United Nations and the FAO are really worried about, is increasing concerns about global food security because of increasing food prices. Now, if we take a quick look at this, how much time do I have, Goran? Okay, thank you. This is a graph from the invasion of Ukraine by Russia. What you can see is until July, right, look at the sort of bluish exports out of the Black Sea ports. So nothing went out of the Black Sea ports. It was either crossing into Western Europe, to the west into Eastern Europe, I should say, into countries like Romania and Poland, mostly by rail or inefficiently by trucks. Some of it went along rivers, but very little, none of it was getting out of the ports. This agreement came into being in August, and you start to see a significant increase in exports from the three major ports, particularly Odessa, increasing through September, although I should point out that these exports are still only about 30% of what they were a year ago. There's still a lot of grain from last year's harvest sitting in the elevators and storage points in the Ukraine. And they've started harvesting, the current harvest is coming in, so there are real concerns about storage issues and the quality of grain that was remaining in those elevators. Now, this is the wheat price, and of course you can see that if you follow this is from the Chicago Board of Trade, so this is wheat futures, this is what the market expects wheat prices to look like in the X number of months ahead. You can see back in May we reached what? Close to what? $13 a bushel. These were record prices. They were the highest they'd been for some time. And they were even quite high before the invasion of Ukraine. Then as we started to get some sense of harvest in Ukraine and what was going on in the rest of the world, prices started to dip. But what's interesting is if you follow these things, about 2 weeks ago, the Russians said they were pulling out of the grain deal. Putin started to play politics with food, and as you can see, prices went up, and then the Russians agreed to go on with the deal again, and prices came down. They're mostly grumbling about the fact that Russia has had a record grain crop this year, but they're not able to export it. Why? Very few importers want to touch Russian grain, and insurers certainly don't want to touch it, but they're happy to touch Ukrainian grain. There's an issue about sanctions and the politics of importing Russian grain. So even though the Russians had a pretty good harvest, they've not been able to export it, and they'd also like to export fertilizers. Russia's a major producer of nitrogen fertilizers and potash fertilizers. So I'm coming to the end. The downside risks dominate this forecast. And these downside risks, I've just listed a few of them. There are many others that I could add to this. First of all, policy mistakes. And I'm going to talk about the UK's September 2022 budget. I shall be as polite as I can, but as a Brit, I think I have every right to be rude about the government of the country where I used to live for 33 years. I don't vote there anymore, but I can still be rude about them. Secondly, policy divergence, and this is where I kind of want to provoke Mark maybe sometime later in the panel. I know he might not be able to answer it, but US rates have gone up much faster than anywhere else, or they've gone up aggressively fast, and this is leading to continued strength of the United States dollar, and I'll talk a bit in a minute about what the implications of that are. Inflation is persisting, particularly energy and food price shocks. Again, I might provoke Mark here by asking, can monetary policy do anything about food prices and energy prices, given that these are largely driven by supply and demand factors, as opposed to underlying expectations about the economy? Halting of if the Russians were to completely halt natural gas supplies to Europe, there would be huge pressure on inflation in the euro area, in a set of countries that already have a very high rate of inflation. And finally, I think this is sort of bubbling away under the surface. It's not something about which I know an awful lot, but there's considerable worsening of the Chinese real estate sector, which I did not know, but accounts for 20% of their GDP. And there's a real concern that there'll be a lot of non-performing loans on their balance sheets of the banks that could cause China's own version of the financial crisis. So let me talk about Trussonomics. This is what the Guardian newspaper calls Liz Truss's policy in her very short term of office. So on the 27th of, well, around the 27th of September last month, or the month before I should say, a budget was introduced where there were unfunded tax cuts. There was no evidence of any thinking about how they were going to fund these tax cuts. This completely spooked the UK bond markets, okay, with that fiscal policy announcement. And it created really serious problems in a very boring part of the financial sector, the UK defined benefit sector. UK defined pensions. So what a lot of these pension firms did, they had been doing was hedging against interest rate drops. Okay, so we'd been through this period of very low interest rates typically being cut rather than increased, and they'd been hedging against these drops by investing in something called liability-driven investment funds. It's just a special kind of derivative where the collateral is bonds, and many of these pension funds, most of their assets are held in the form of government bonds. Why? Because they're paying off defined pensions 30 years from now, so they invest in 30-year UK treasuries, which we call gilts, by the way, gilt-edged securities. That's where that terminology comes from. Well, bond prices fell. If bond prices fall, what happens to yields? They go up. They do exactly the opposite of what they were hoping when they hedged against interest rates dropping. Suddenly, the counterparties said, we want to be paid. It was like a margin call. So these LDIs, these liability-driven investment funds, suddenly sold off a bunch of bonds to generate cash. What did that do? That drove down bond prices even further. It drove up yields even more. I think they called it, was it the doom cycle? I think it was called the doom cycle. And what happened? The Bank of England that had been trying to get out of its quantitative easing, which was where they'd been buying bonds and was to get out of it and to go back to targeting inflation through the use of the interest rate, it had to step in and buy up bonds in order to shore up the bond market to stop the pension funds going out of business. And very quickly, I don't know if you can see that, that's Liz Truss being ejected from 10 Downing Street up in the corner. These are gilts, right? So let's look at, we've got the pale blue is the UK gilt, the orangey one is the US bond, 30-year treasuries, and the purpley one is euros. So yeah, yields were higher on UK bonds already. The Bank of England coming and raising rates, right? You get a modest increase in gilt yields, then we get Trussonomics. And what you get is, I'm going to say, you get what Paul Krugman called the moron risk premium. Suddenly, British debt we weren't going to go bankrupt. We weren't going to default on our debt. But the markets are basically saying, if you have underfunded tax cuts, the bond markets are going to react. Then the Bank of England comes in, and look what happens to bond yields. They just go back down again because the markets are calmed down. But what's interesting is you see this movement in other bond markets. So there were spillover effects from the British bond market, which was just an incredible reaction to a stupid piece of policy. I mean, apparently she didn't even listen to the right-wing economists who were advising her, saying, you might want to test this out before you actually fully bring it to the market, which I find kind of interesting. So let me finish here on the impact of a strong dollar. So the increase in US interest rates then has led to basically financial foes pushing up the dollar. This hurts emerging economies who rely on food and oil imports and typically borrow in dollars to pay for them, and they're priced in dollars. So the impact of the Russian invasion of Ukraine has been exacerbated by the rise in the dollar in terms of its effect on prices. So what's concerning about this is the potential for a sovereign debt crisis, and the IMF and others are particularly worried about this. And there are several countries in the emerging economies who are already in default, and I list Sri Lanka here. Russia and Ukraine are both in default as well, but I think we need to put that down to the war as opposed to what's going on globally. And there are other economies that are in severe stress. I mean, even Britain has been downrated in terms of its risk ratings. So, again, you can't see that very clearly, but I think this is where I want to finish. The simple takeaway from this graph is the very high percentage of GDP where that emerging economy debt is denominated in dollars. And I think that's the graphic that was in one of Krugman's articles in the New York Times. So my finishing point is, and it's sort of to again, Mark must be fed up with me trying to provoke it. I do it every time, right? I'm like Bob Dylan and his band, right? I change the key of every song that I'm going to sing just to annoy my bandmates, right? The question to Mark is, and this is not me, this is a debate going on amongst economists, is the US pushing up its rates too fast and causing very negative spillover effects into the world market, particularly for emerging economies who are importing dollar-denominated commodities? Investment is leaving those countries, flight to the United States dollar and dollar-denominated assets, plus this diagram here. So on that point, I finish. I'm sure I've gone over time, but I really appreciate you listening, and I look forward to the questions in the panel afterwards. Thanks very much.
Challenging.
Yeah. Well, as Ian suggested, you know, it is a bit of a challenging time, and so that's the name of the presentation. And I'll talk to you a little bit about some of the issues that are going on, but we need to start with my annual effort to keep my job, which is my disclaimer. So yes, these are my views and not necessarily those of the big bosses. So I want to talk about recessions. Ian's definitely trying to remind you that there are, you know, major downside risks out there. I'm going to talk to you a little bit about that in terms of output. We'll talk about recessions also in terms of the labor market, and then, of course, high inflation. And I won't neglect Federal Reserve policy, just for good measure. So 2019 came. It was the last time we were here, and then after that, there was quite clearly a recession, and it was obvious there was going to be a recession right away, because if you close lots of things, you don't have any output. And that is, of course, what happened. And, you know, from a quantitative perspective, this is immense. These sorts of GDP drops on an annualized rate don't happen. But they did happen to us. And we saw, actually, a relatively quick recovery. So one of the points that I want to make today is a lot of what we get out of sort of thinking about the macroeconomy is we look for past business cycles and we try to think about how they were and what that might tell us about where we are today. And that is going to be really hard with this, because the last business cycle that actually resembles this would have been the Spanish flu. And we don't actually have very good data on that. So I want to point out the right-hand side is, you know, we have recovered a lot of our growth. We have recovered a lot of our GDP, but we're actually bouncing around a little bit over there, and we still have some negative quarters. And that's caused people to question whether or not we're already in a recession. So to think about recessions and normal patterns, I like to use this chart where we have an average of business cycles from the 1940s onward, and that's the green line. And you can see that the green line means that, you know, in a recession, you drop and lose about 2% of GDP. Well, you know, we were prior to this, and when I first came to Ohio Wesleyan, we had the financial crisis, and that was the Great Recession. And we lost almost 5% of GDP in that, and that was really extraordinary. But you can see that, you know, the actual pandemic has a much bigger loss, but a very different pattern. This is not a typical pattern in any way, shape, or form, because the bounce back is very steep, and then what happens after you have a bounce back isn't really clear. It's not our normal recovery. This recovery is showing up in terms of output in all sorts of different ways. So most of the time I would come here and I would say, well, you know, you're all in classes, you got C plus I plus G plus net exports. Well, we could do that. And C is normally the thing that we pay a lot of attention to, because our consumption of goods and services is about 70% of our total economy. So most of the time, that's going to tell you whether you're in a recession or not. Now, we have those two negative quarters of growth there, those 2020 quarter one and quarter two. Those are both negative quarters, but the yellow area, our consumption, was actually continuing to grow. So in the US, we don't just treat two negative quarters as a recession. The MBER looks at a lot more data. if we were to eventually go into a recession, they would undoubtedly back it up and date it back to here. But without that, we don't look at this as a recession because fundamentally a lot of the economy was doing well, but we went from having a real excess of inventories. And so this was Target and Walmart announcing they had too many goods and that they had made misorders, to cutting back on that, to change in our economy. And one of the changes that we'll definitely come to is on the investment side, we're seeing residential investment slowing. So business investment has actually continued pretty well. So high interest rates matter. If you want to, affect the economy, you're going to go through interest rate sensitive sectors. Housing is it. If you look over there on the right-hand side, our recent housing data, housing sales, whether new construction or existing homes, have dipped rather sharply. If you look back, you can actually see, well, they're dipping actually similar to the pandemic. So we are seeing a really abrupt change in housing, and that's definitely something that we're going to have to pay attention to. That said, at the same time, we're seeing some of our other supply issues less constrained. So if you were out looking for a car a couple years ago, car prices were extremely high. It was not easy to find a car. The car lot didn't have the cars. Those sorts of supply constraints are gradually alleviated. So you can see that U.S. vehicle production's finally starting to improve. And that'll increase the sort of availability of cars and should help with the pricing of cars as well. So there's both positive and negative news on the output front. When it comes to what the FOMC says about today's economy, they're expecting this year to have, very low GDP growth. In fact, they're basically forecasting a little bit above zero, which is weaker than the IMF's forecast for 2022. This is a chart that tells you, about sort of where we think we are, but it also will tell you that 2023, the FOMC is still expecting growth to be below the longer run trend growth of around 2%. So in this environment, we don't just focus on output, and we think very much about sort of thinking about the labor market as one of our key indicators for sort of how the economy is faring. And the labor market has two sides. So right now, you've got a huge amount of hiring. So I've got no hiring, and you've got, at the same time, I'm quitting. So we'll take a look at both of those. And you'll see that actually, I think one of them is really relevant and the other's not quite as relevant. I want to remind you, again, because this is just such a dramatic figure, that the pandemic is extraordinary. So these are one of the highest frequency bits of data we get in the US economy. It's weekly unemployment insurance claims. It's how many people went to the unemployment insurance office. And you can see, if you look back to, a little bit past 2007 there's the Great Recession. This was the largest shock that we had seen since the Great Depression. It boosted unemployment claims substantially. And it's entirely dwarfed by the pandemic. The pandemic is an extraordinary economic event, and it is not a normal business cycle. So payroll levels have been gradually recovering. We've been seeing continued payroll growth. The latest month was 261,000. And so in that sense, it's really hard to argue that we are in the midst of a recession already. The unemployment rate is down to 3.7%. That's an extraordinarily low rate. That is a very tight labor market. That labor market is extra tight because if you look at the labor force participation rate, that's kind of our summary of who's actively engaged in the labor market. Labor force participation doesn't normally shrink during recessions. So you can't really see the recession markers here, but that sort of post-2008 period, you don't really see labor force participation doing anything. In the pandemic, of course, many people chose to leave the labor market. Many people had to leave the labor market. Many people were sick. Many people were taking care of someone who was sick. Many people were taking care of children. There were a lot of reasons why people left the labor market, and many of them have not come back. So when we think about the tight labor market, and I want to think about today and not dwell on sort of, looking at sort of past recessions as our example, I think one of the best statistics is really about openings. So if you look at the history here, you can see that normally we have, significantly more unemployed people than we have new job openings. That's a perfectly ordinary labor market. The pandemic, of course, was a huge shock, and we had a lot of unemployed people. But over time, we've come to have significantly more openings than we have unemployed people. This is not a normal thing either. And we'll talk a little more about what that implies. So a lot of people look at that and say, well, that's a pattern of the Great Resignation, that people have decided they don't want to work anymore. I don't really buy that. So here, of course, quits do cause openings. If someone quits a job, then suddenly I've got an opening. That you can see, quits have risen somewhat. But that isn't really what's going on here. Openings rose without any sort of direct implication from quits. They rose considerably more. Businesses actually entered the sort of post-pandemic period just wanting more workers, wanting to expand, and wanting to expand more than they had previously. So on the side of thinking about sort of how is our labor market going, we want to pay a lot of attention to the openings. The openings have to come down. We can't sort of run the economy with this many openings. And they are coming down. So I'll talk a little bit more about implications for that. So in terms of having a recession, you are expecting to see unemployment rise. We do not have unemployment rising most of the time without a recession. That is the tricky path that the FOMC is trying to essentially go through now, is we need a less tight labor market. They're expecting unemployment to rise, but not maybe enough to qualify as a recession. All right, so everyone's talking about inflation these days. So just as an offhand note, several years ago when I was research director, I said, Cleveland Bank's pretty good in inflation. We should have an inflation research center. To which most people said, why would you study inflation? Nobody's interested in that. So eventually, it comes around. So inflation is high, and it's very broad-based. And, Ian showed you plenty of things. Internationally, it's actually probably worse. In the U.S., we're looking by the Federal Reserve's preferred measure at about 6.2%. You can see on the right-hand side, I've got little dots. Those are our nowcasts. We're seeing gradual declines in inflation. But there's no question that if your target is 2%, which is the red line there, inflation is too high. And it's going to be a while before we come down to those levels. And it's true whether you're looking at headline, which includes oil prices and energy prices and food prices, or you're looking at core, which excludes them, or you're thinking about just, typical prices in the trim mean. It doesn't really matter. Inflation is too high. A lot of that inflation is coming actually from goods rather than services. So in this case, Ian's done an excellent job of introducing this entire problem. You've got energy prices, you've got food prices, we've got supply chain problems, goods are the problem. Goods inflation rose a lot. We in the Federal Reserve are actually probably at least as worried about the fact that the services inflation is picking up. So when you think about inflation, you're thinking about all the goods that you buy, all the, things. But actually, as consumers, we buy more services than we buy goods. So that may not sound that likely to you, but when you think about the fact that housing is a service, it's not a good. And so when we measure it in terms of inflation, we include it on the service side as having service housing services and rents and healthcare and all of the things that we, sort of take for granted. The fact that services inflation is ticking up is more long-lasting than goods. Goods can come down, they can go rather steeply. You can see that from the chart here. But it does matter a lot that goods inflation is extraordinarily high. And most of the time, in fact, a slight majority of the time, goods inflation is typically negative. Now you might think, hey, I haven't gotten any discounts on my goods. You're getting them all the time, but it's all on quality adjusted basis. So you think about that new phone that you got, with more memory, faster processor, bigger screen. It came basically at the same price as the old one that you had 3 years prior. When you adjust for the quality change in that item, then the price becomes negative. So that's what we've had for a long time. Technology has given us that across a whole bunch of different products, but right now that's not working. So we're very focused on the service end, and on the service end, wages and salaries are the key part. And here's why I want to be a little bit optimistic about, thinking about the inflation outlook, thinking about the path for policy to not go through a recession but see inflation come down. So I talked to you earlier about openings, and job openings are really the strongest indicator we have about sort of a really tight labor market. And job openings are starting to come down. Well, that matters because people who are getting new jobs get new salaries. And they are a big part of what goes on in wage and salary inflation, is actually the changing of jobs. So when we see job openings coming down and a settling and calming of the labor market, it's actually not out of the question that we could see wage and salary growth moderate as well. And while as a Federal Reserve economist, I definitely want to see wage and salary growth helping the benefit workers, I also don't want to see it so high that it's causing inflation to continue to rise. We need to have these things in balance. And I wanted to show one particular case. So I looked at this across a bunch of different industries. This is leisure and hospitality. So this includes all the restaurants and things, and it's the place where we've seen the sharpest rise in openings and the sharpest rise in wage and salary. So you might think, oh, it's all about those finance guys making all the money. No, actually, during this period where you've seen prices rise for wages, it's been primarily out of, food service, hospitality, the things that were really impacted by the pandemic. And those areas are actually some of the areas where we've seen a little bit of pullback for a longer time. And so we have seen a little bit of a settling in wage growth in those sectors. So that makes me a little less that, this is a pretty optimistic looking forecast. So the FOMC has to sort of have a policy where it says it's going to get to 2% inflation. So we're not officially an inflation targeting bank. Federal Reserve System targets two targets, both full employment and inflation. But that outlook needs to show that we're going to have a policy that will actually get inflation down. And that's a pretty aggressive path. So that'll either happen through rates have to go even higher, or it can happen because some of our reaction to the pandemic will abate. So Ian pointed out rates are up a lot, and I wanted to show that as well. We've had multiple 75 basis points or 3/4 of a percentage point rises in interest rates. That's driven up rates that actually affect us. Of course, none of us, you nor I, can borrow at the federal funds rate. And that's a rate that banks charge each other overnight for riskless borrowing and lending. So we don't get to participate in that. But the 10-year Treasury is actually kind of the benchmark that determines what mortgage rates look like. A 2-year Treasury will tell you something about what the increment, once you add a risk premium to, is in shorter-term consumer debt. And all of these things are rising, and that is, sort of necessarily slowing the economy. The FOMC as of September said, we're getting close to rates being as high as the committee expects they need to reach. We're not quite there yet, but it's close. At the latest press conference, the chair said that, since that meeting, the news hasn't been that great, and we probably need to go higher and stay there longer. So overall, there's no question we've got some slowing. We've got a very uncertain output growth. I don't think there's a recession as of yet because labor markets are still tight. I don't think a recession is necessary, but it may happen. It's not a normal path to try to get your unemployment rate up, and so that's an unusual outcome. And inflation is really the focus these days, and it remains high, but I do think there are hints of it slowing. So with that, I'm happy to turn it over.
Well, good evening, and thanks a lot for having me back. It's great to be back at the same old stand with the same old crew and having so many of y'all in the room. This is a bit of a bait and switch. If you've been here for previous years, this isn't the first time I've done this to you. I actually do not have a Central Ohio forecast at this point. More about that later, though. Meanwhile, what I'm going to do for you this evening is focus on what we know now about the Intel development. Intel has started construction of a semiconductor manufacturing operation in western Licking County, where that red arrow is, just northeast of Columbus. This is Ohio's biggest economic development project ever, and that's why I think it's kind of worth talking about. I actually started looking into the workforce implications of this project as soon as the news came out last January. And now I'm collaborating with my friends at the Mid-Ohio Regional Planning Commission, or MORPC, to figure out the population implications for MORPC's 15-county region. Under development now are the first of two fabrication plants, or fabs. Semiconductor production will start in 2025. These two fabs are going to employ 3,000. Intel's plans are actually to build 6 or 8 more of these fabs over the next decade. Assuming that each one of these fabs is of equal size, that means employment of 12,000 to 15,000 by the mid-2030s, which would make Intel Central Ohio's largest private sector employer. Another project that I'm starting to look into, kind of off to the side, is a Honda battery plant that's going to be built in Jeffersonville, 40 miles southwest of downtown Columbus. It's going to employ 2,200. In normal times, that would be a big thing and everybody get all excited, but I mean, 2,000 versus 12,000, 15,000. Poor Honda. But they're also going to upgrade their 3 existing plants in central Ohio, central and northwest Ohio, and employ 370 some additional people on top of what they're employing now. But the Intel project is going to bring Central Ohio and the state many, many benefits. First of all, it's going to create a new industry for our region and our state. We've never been big in semiconductor manufacturing. Now we will have the largest U.S. operation eventually. It's going to increase the technology workforce in Central Ohio and give well-paying jobs to people who need them. And it's going to enhance our reputation for high-tech manufacturing employment, which really does matter. But it's also going to bring some significant challenges. Workforce and housing and roads and other infrastructure and schools and hospitals and other community services, and that's what I want to kind of focus on. If we don't manage these challenges carefully, this dream development could turn into a nightmare. Fortunately, we've been planning for growth for years here in Central Ohio. Back in 2015, the Insight 2050 study projected that our 2.1 million population region would grow to 3 million by 2050. Even before this news, the Intel news, more recent analysis confirmed that projection. Now, we have to make the long-range planning that we've been doing a whole lot more short-range. So the first challenge is the construction workforce. There are about 500 construction workers on site there now. According to Intel, construction employment is going to top out at 7,000 on site all at one time before the first fab opens. And hundreds more are going to be needed to improve the roads around there, the utilities, build facilities for suppliers, and so on and so on. And as long as the work on the fabs continues over the next decade, construction jobs should continue in the thousands. Even after that, after the last fab is finished, the older fabs are going to need to be modernized and retrofitted. And so we can expect a significant number of Intel-related construction jobs permanently. Now that's 7,000 maximum, just to give you a little bit of perspective, is 15% of the 46,000 construction jobs in the Columbus metro area now. And those folks are doing other things. And so it is going to be a bit of a heavy lift to get 7,000 construction workers all in one place, all at one time. They're going to come from throughout the state and well beyond. There are going to be many construction workers in RVs, in motels, and in other temporary housing near the construction site. On top of the production and construction jobs, there are going to be thousands of other jobs that we call indirect and induced. Intel currently has about 140 suppliers in Ohio, and they expect to bring in 30 to 40 more. Those supplier jobs, which will exist only because Intel exists, are called indirect. The existing Ohio businesses supporting Intel are going to get busier and bigger, and then we're going to have 30 or 40 other suppliers that are new to Ohio. Now, the Intel workers and the workers of the supplier firms are going to need to buy cars and groceries and eat out in restaurants. And that's going to create more jobs. We call those household supporting jobs induced. Economic impact analysis tries to quantify the indirect and induced impacts of some new activity, and that is a major part of my practice. The problem, though, is that standard economic impact analysis techniques assume that the new activity is not big enough to change the underlying economic structure of the region that you're looking at. And that assumption is very clearly and very forcefully violated here. Now, a recent Intel study estimates statewide employment impacts of 5.1 to 5.7 total jobs for each Intel job in 3 states with existing operations, namely Arizona, New Mexico, and Oregon. Now, we have to approach this study really cautiously because it was done by or for Intel. And Intel clearly has an incentive to make that number as big and as sexy as they possibly can. But this is the best estimate that we have now. Now, because Ohio's economy is bigger and more diverse than those of Arizona and New Mexico and Oregon, Ohio can expect to trap a higher share of our Intel operations' total spending. So we can expect an indirect and induced impact, at least that large, maybe bigger. Now, much of that impact is going to be concentrated here in central Ohio because Intel wants their primary suppliers as close to their fabs as they possibly can have them. So the construction impact will be on top of this operating impact, and it'll be eventually around 1 additional job for each direct job, less than that in the early years. So if we get those 15,000 jobs, even an employment impact factor of 4, which is fairly conservative, translates to an employment impact of 60,000 additional jobs. The population impact could be more than 170,000, and that's why Morpsey and I are so worried about this. Now, some folks, and I've seen this in the dispatch actually, are pointing to Intel's goal to focus on local hiring as a reason not to worry that much about the population impacts. But what that argument forgets is this: every worker whom Intel hires is one who's not available for existing employers. So most of those jobs are going to have to be backfilled. The higher wages that Intel's going to pay, and they will be paying above market, may cause some employers to leave jobs unfilled. And some employers who are here now may move somewhere else where the wages are more economical. But we're going to get lots of new residents in central Ohio, one way or another. Now, figuring out that total population impact is necessary but not sufficient, because you have to come up with an idea of where these folks are going to live. Here is Morpsey's map of a 1-hour rush hour commute. That includes part or all of 22 counties and the cities of Marion, Coshocton, Circleville, Zanesville, and London. Now, a 1-hour commute is certainly long, but it's not out of the question. Even now, 5% to 9% of workers in those remote counties commute an hour or more daily to work. Now, one reason to think that there are going to be long commutes in a big geographic labor shed is that we in central Ohio, particularly in Franklin County, have been underbuilding new housing for at least a decade. House and land values in Licking County are already being bid way up. The same thing's going to happen in Columbus. House prices and rents in those remote counties are a lot more affordable, and they're likely to stay a whole lot more affordable. So Morpsey and I are thinking through these detailed locational projections, but they're not fully baked yet, so I can't share them. So let's talk about wages. Intel has been promoting a $135,000 average wage. Now that suggests, if you don't think about it very hard, that all Intel workers are going to hold advanced degrees and make huge salaries. But that's incorrect. That $135,000, first of all, includes benefits, which you can't spend on anything. And because it's a mean and not a median, it overstates the payroll of the typical worker. The jobs are going to pay well, no doubt about it, but most of them are going to pay far less than $135,000. Now, my analysis suggests that about half the jobs in the semiconductor manufacturing industry are open to people with only a high school diploma plus a year of training, some of which Intel's going to supply. I did a really deep dive into semiconductor manufacturing occupational wages. I sure know how to live. Even if Intel pays well above market, which they're going to do, as much as a third of the jobs are going to pay less than $50,000. And that's the unfortunate thing about that $135,000 figure that Intel's been tossing around. It suggests that we don't have to worry about workforce housing and apartments, but we do. We also have to increase density and stop chewing up farmland, but that's one of the main recommendations of the Insight 2050 study, so we've been working on that for some time. Keep in mind, too, that the 8 to 10 fabs are not guaranteed. If we don't deliver on workforce or Intel's other requirements, they're going to take their fabs someplace else. All of this, though, is begging a big concern of mine. All of Ohio's economic and population growth is centered here and to some degree in the Cincinnati area. Much of the rest of the state is struggling and shrinking. And that's a big problem, and it's one that we here in Central Ohio need to care a whole lot more about than some of us do. And I certainly hope that other parts of Ohio can get some of that supplier activity. Now, just to wrap up, to atone for my bait and switch, let me put out my standard shameless plug. I'm going to be releasing my 24th annual Columbus Economic Forecast at the January 4th Forum of the Columbus Metropolitan Club. You're all welcome. And if you can't be in the room, you can live stream the forum on the Metropolitan Club's YouTube channel, which you can get at columbusmetroclub.org. Meanwhile, you can certainly ask me a question about the Central Ohio economy if you want. I'll give you some sort of an answer. Thank you very much.
Thank you for these wonderful presentations. I have a million questions, but I'd rather let our audience ask any questions. So if you have a question, please let yourself known, and there is a microphone that you're going to be given so we can all hear you. If you could introduce yourself, that'd be great.
Can I start? I am Sanya. I'm a senior here with a major in computer science and quantitative economics. I'm an international student from India, and my question is to Ian. So as someone from UK, we know the Brexit happened, and then followed by the death of the Queen recently, and then Prime Minister Johnson resigned, Truss resigned, and now we have a South Asian Prime Minister. So recently, there have been, when Brexit happened, before that European workers could work in the UK with a residence card. At this point, Rishi Sunak is talking about just tightening the immigration policies in this state of economy. And as we have discussed in classes before, immigration policies directly affect the economy. So I just wanted to hear about what are your thoughts on all of that is happening right now. Thank you.
Wow, that's a long question. Brexit, economists head explode. To my mind, Brexit was one of the largest shots in the economic shots in the foot that the British economy could have made. As a trade economist, I can tell you that the most popular equation in international economics is the gravity equation. Essentially, it says, think about the laws of gravity. It says large objects that are close to each other are attracted to one another. And cutting ourselves off from our largest market has always struck me as an incredibly foolish act of economic suicide. And right now, I think, finally, even members of the Conservative Party who perhaps were lukewarm supporters of Brexit, if not rather quiet remainers, have started to suggest that the true economic cost of Brexit, now that the pandemic is sort of waning, is starting to become pretty clear in terms of customs, paperwork, barriers at the border, et cetera, and to the point where we actually had to relax our rules on immigration in order just to get truck drivers a year ago to shift goods. So truck driver shortages have been fairly common, not just in the United Kingdom, but here in the United States. But I think that was heavily driven by Brexit. So I think the Brexit chickens are coming home to roost right now, is my opinion. And I'm a trade economist, so you'd expect me to say that. And I would say that the first time I voted in the United Kingdom was in 1974, when I voted to go into the European Economic Community, which was the precursor to the European Union. Now, it's really interesting to look at what really drove the Brexit vote, and a lot of media observers thought it was actually fears about immigration, and you would hear unpleasant stories about, do you want a Romanian living next to you, or something along those lines in the more tabloid newspapers in the United Kingdom. But in the build-up to the Brexit vote, particularly the language of our friend Nigel Farage, who has sort of led the very conservative anti-EU positions. The Guardian newspaper likes to call him Nigel Fromage, just to poke fun at the guy. But the research is really interesting. There was a very good paper published actually in a Journal of American Political Science by two Italian economists a few years ago, where they were able to show that the most important thing that affected the Brexit vote was not immigration. It was actually the impact of the Chinese import shock. And you could see they carefully tabulated votes for Brexit against where the import shock from China was most intense. And so I think really what happened was that there was a translation of the Chinese import shock into let's blame everything on the European Union. And of course, most of the Brexit campaigners really pushed hard on the immigration issue. And of course, we've seen a big decline in immigration from the European Union because of the end of the single market. And we've also seen a lot of out-migration from the United Kingdom, where folks have not been able to establish rights to live in the United Kingdom, or they've gone, there's a lot of sort of subtle racism and stuff that's been sort of brought out. Unfortunately, a very unpleasant genie was released from the bottle. Now, going back to the question, so Rishi Sunak, of course, is born of Indian parents, but he was born in the United Kingdom. And I would say he was born with a silver spoon in his mouth. To use an English metaphor, he went to Winchester, which is the other major public school after Eton, and he got a degree in PPE from Oxford, and then he went to Stanford and got an MBA, and then he worked for, I think it was one of the big, I forget which investment fund he worked for, Goldman Sachs, that's right. And of course, he's married to the richest person in the United Kingdom. His wife is the daughter of the Infosys entrepreneur in India. She is actually richer than the Queen was prior to her death a few weeks ago. Now, you asked me about the Queen dying. I'm in a very small minority in Britain who are not very pro the monarchy, so I'm just going to leave it at that. Other than the fact that I respect somebody who sat on the throne for that long and saw as many prime ministers as she did, and I like to think that she saw off Boris Johnson and Liz Truss. So what's interesting is that if you go back to Liz Truss's economic objectives, her push was for economic growth. And I think there's nobody in the UK that would agree, nobody disagrees that economic growth is a good idea. And a lot of it's due to low investment in productivity and technology over the last 15 to 20 years, be it in the service sector or elsewhere. So nobody disagrees with that argument. I think that the disagreement is about the policies that we get to achieve that. But I think one thing that Prime Minister Truss, in her very short period in office, by the way, she campaigned for the job longer than she was actually in office, was to relax immigration, particularly from Southeast Asia, and including the Indian subcontinent. And Sunak himself has said that he will continue that policy. And now this seems inconsistent to me, that we don't want immigration from the EU. Most of the immigrants from the EU were not actually low-skilled, low-wage workers. They were mostly workers going into things like the healthcare sector, the education sector, and there's been this huge out-migration of workers from the healthcare sector. So I think there's this just seems inconsistent to me. I'm not against immigration into the UK from wherever it comes from. What I'm probably more concerned about is the way we're treating asylum seekers, the folks who cross the channel in order to escape as refugees from, parts of Africa, parts of the Middle East, and so on. And of course, that's recently been highlighted by the appointment of the new Home Secretary. So I guess overall, I think immigration has been positive for the UK economy. Most of the studies by Richard Porters, who is an economist at the University College of London, has shown that immigration from the EU, which was mostly high-skilled workers, was actually beneficial to the UK economy. They contributed to economic growth, they paid taxes, they were useful citizens or useful people living in the United Kingdom. And this idea that it was an influx of Polish plumbers, that was what the Sun newspaper used to talk about in the 2000s, is sort of a myth. In fact, most of them have gone back to Poland because they came to the UK. What happened to wages in Poland? Wages went up, so they all went back home again. Well, not all of them, but many of them did. So, long answer to a long question.
You three have probably got a better seat as analysts and academics looking at how economics has been practiced over the last 20, 30 years. Impacts of the pandemic, impacts of globalization, impacts of a proxy war, Eastern Europe between Russia and the West. What's the state of economics in terms of how it's being practiced today? Is it being weaponized? Is it being utilized properly, in your opinion, both on an international scale, a national scale, a local scale, in order to create good? I mean, I think we all believe that practicing economics is obviously there's scarcity of all sorts of things, and we're all trying to do our best to, use those resources, both at a local level and an international level, to create prosperity and in a broad sense, create equality so that people can live their lives in a free way. Do you believe that economics today is being practiced in a way that is better than it was 30 years ago in the 70s when we had the oil embargo? Or do you feel like we've learned things over those years that have allowed us to become better practitioners at working the levers of economies to affect those good outcomes?
Okay. Yeah, it was a really challenging question, and I'm happy to sort of comment a little bit about it. But I mean, I guess it's, I think it's always hard to compare and say, 30 years ago things were better or worse. What I think, at both times, economics does a lot of good. It's very useful to pay attention to sort of what caused what. How do we define that better? I think academically and as a as a research community. I think economics has gotten more sophisticated about how it models things and how it connects changes in policies to outcomes for people. I think, you always have an issue about where do economists focus their attention. I think we, have a very large and, robust conversation about how we can improve the outcomes for less well-off citizens or, less well-off people worldwide. So I think, those are all good things. I think, one of the challenges that economics faced 30 years ago and continues to face today is that economics being, the most directly politically relevant part of the policy discussion, we're always at risk for sort of seeing politics intervene in analysis, or to see politics intervene in opinions. I think that was true, 30 years ago, 20 years ago, 10 years ago. It's still true today. It's a difficult thing, and I think, working on public policy issues, I don't think we can get away from that. But I do think the profession has made useful progress in sort of how do we analyze things.
Well, you've hit on one of my major soapbox issues, and I'll try to be brief. There's not a whole lot of economics training that focuses on local economics. Some, certainly. I wish there were more, because the work that I do around Ohio has given me the opportunity to directly help economies, to help people. Ben Bernanke said that should be the goal of every economist. But a lot of my work involves looking at the interface between educational institutions and business. Are the educational institutions preparing their students, their graduates, with the skills that employers really need? And so to the extent that I can illuminate what employers really need, then if the educational institutions then take that up, then you have better prepared workers, you have more profitable, more productive employers, and you have greater strength in the overall economy. I did a whole lot of work a few years back in Appalachian, Ohio, and believe me, it was the most fulfilling gig I ever had. So pay attention to local economics.
Well, I'm going to swing from local to international, and I guess as a practicing trade economist, if I'm just thinking in my office, I think about the last, I think you said back to the 1970s, I think globalization and the period of what we call hyperglobalization from about the early 1980s through to the financial crisis, it's very clear that that globalization brought a significant number of people out of poverty. If you just think about China going from where it was, the death of Mao Zedong, through the reforms of Deng Xiaoping, through I won't include the current president in that analysis, but the opening up of China led to bringing a huge number of people out of poverty. And certainly what's happening in, the question was about India, the Indian economy after it was opened up, more flexible markets, less protection, has significantly grown. So we've seen a huge number of people brought, and there's clearly a correlation between trade and growth. I mean, it's probably a virtuous circle. Increased trade increases growth, increased growth increases trade. And just as somebody I actually spend most of my time working with a trade lawyer these days at Ohio State, writing law review journal articles as opposed to economics papers. And the issue that we tend to spend most of our time in the coffee shop talking about is how the key institution of the post-war period that has moderated international trade, what was formerly known as the GATT, the General Agreement on Tariffs and Trade, now the World Trade Organization, which came into being in the mid-1990s, has essentially become a moribund organization in some sense, because we haven't had any trade negotiations since 1994. The Doha round was a failure, and there are all kinds of reasons why it did fail, and I don't want to bore you with those reasons. But more importantly, I think the great advance of the WTO was a properly functioning dispute resolution mechanism that couldn't be stymied by large players like the United States or the European Union or Japan. And as I said in my presentation, we haven't had a trade war since the 1920s, 1930s. And the kinds of tariffs we saw in the post-war period after the Smoot-Hawley tariff was introduced in the United States. I think the undermining of the dispute resolution mechanism, not just by the United States, but by some other big players, is fundamentally a bad thing, that we have no way of resolving trade. So even though we're not negotiating on anything new, we ought to be ensuring that the rules that we've already agreed on are being enforced. So I think that's, from a legal economic standpoint, is a bad thing. But if we think about the China import shock, and globalization generally, and if we think about a lot of people being brought out of poverty in the developing world, on the other side of that is that this import shock has had a significant impact on certain industries in certain regions of the United States and in certain types of labor in the United States. And I've already referenced what happened in the United Kingdom, and it also happened in the European Union. In fact, if you go back to the early 2000s, most economists would say globalization wasn't really having that much of an effect on jobs here in the United States. Then we had the China import shock, and in a period of 7 years, I think imports went up by something like 1,000% from China. And at the same time as we had this import shock, I think, particularly in countries like the United States and the United Kingdom, political scientists talk about economic liberalism, and the idea of economic liberalism was there was a trade-off between globalization, which would benefit a certain number of people in an economy, but would potentially harm others in the economy, and that there would be some sort of social safety net or compensation for the losers. And I think that has broken down, and that import shock, and economists have actually been doing a pretty good job of modeling this, have shown that you get this big import shock, you get this bifurcation between those who benefit from globalization, those who are hurt from globalization, and you see this sort of more extreme polarization in voting behavior and attitudes towards things like globalization that's fed through into populist or support for populist economic policies, both here in the United States and in Europe. And those policies then get, what you see as nationalistic economic policy, and which is why we've seen this big drawback from globalization post the financial crisis. Of course, the pandemic didn't help. So I think that's been pretty significant, that economists, if you go back, I'm talking to the undergrads in the room, we like to tell our students that all we need is potential Pareto improvement, right? So as long as the benefits outweigh the costs, we should go ahead with the policy. So think about what I just said. It's a potential Pareto improvement, but any good welfare economist would tell you, you don't want just you want to make some people or all the people better off without making anybody worse off. And I think that's the piece of the story that economists have done a remarkably bad job. We're very good at thinking about efficiency, but we're not so good at thinking about equity and distributional effects. And I think trade and labor economists have finally come to the table on this. There's been a lot of good research on this in the last few years. And then the other quick point I wanted to make, Goran, was what I think globalization has highlighted, and 20 years ago, environmental economists didn't talk to trade economists, or maybe 30 years ago. And now trade economists and environmental economists are exchanging ideas all the time. Why is that? Well, of course, international trade has an impact on carbon emissions, has an impact on the environment. And I think there's a lot more thought going into, is trade policy a good way of dealing with climate change? How do environmental policies affect international trade and globalization? So that's how I would respond to the very interesting, very big question from the gentleman at the back.
Well, we'll have time for one quick question if anybody has.
Good evening. Thank you for being here. My name is Jeremy, and I'm a finance major at Wesleyan University, and I'm doing my third year here. So we all know that the U.S. currency strength is an ongoing problem for not only for countries who are importing goods from the U.S., but also for U.S.-based companies whose parts of revenue come from international. So my question is, what would be the key factors to help, drive down the current strength of the U.S. right now? And is the FOMC future interest rate expectation the only, thing that would affect this current situation? Thank you.
Yeah. So the FOMC is targeted, as we were saying, on two things. One is the full employment of the U.S. workforce, and the other is inflation. Those two factors are saying that we need higher interest rates now to reduce inflation. And those higher interest rates are what are making for a relatively strong dollar. So at this point, we're not surprised to see the strong dollar. We do look at shocks from abroad and how those can affect the U.S. economy. But, the FOMC, in some sense, it's probably right that you can't target the whole world. We need, to have a stable, efficient currency for ourselves. A stable, efficient currency is helpful for others as well. It is a very difficult time period for many countries with inflation being as high as it is. And so we need to do our part to solve that. There's no question it's a challenge that the strong dollar will limit U.S. growth and will restrain U.S. growth, but it'll also cause challenges for countries that face dollar-denominated prices.
Of course, the dollar appreciating is actually beneficial for keeping down U.S. inflation. It means that we can import goods at a lower price. So that's a good thing. And of course, countries whose currencies are depreciating against the dollar, given that most, the dollar is still the world's vehicle currency. Most trades are denominated in dollars. So dollar appreciation is not necessarily good for foreign inflation. The economics I did actually have a slide that I ended up excluding because I thought it was a bit geeky, and it was mostly designed to see if I could provoke Mark into answering my question, and he's punted slightly, I think. No, that's unfair. I always get to tease him, and he can't answer back because he has his bosses to be. I can pretty much say what I like, right? There's a debate going on in the economics profession, and this came out at the Jackson Hole meetings, I think, of the Federal Reserve a couple of months ago. So Morris Obstfeld, who's a previous chief economist at the IMF, he says we see this cycle of dollar appreciation and potential for debt crisis and financial problems in particularly emerging economies, and we're seeing that cycle right now. And his concern is that if the United States Fed pushes too hard, there are these negative spillover effects that I alluded to, and I think that you're referring to. But on the other side, you see economists saying, no, the number one priority of the Fed is to squeeze out inflation in the United States. And I think sort of there's a balancing act here that if the United States doesn't squeeze inflation out of the U.S. system and the U.S. goes into some sort of, I wouldn't say stagflationary situation, but recession with still moderately high rates of inflation, that this has negative spillover effects on the world economy. So, and I think it would be awfully optimistic to think that there could be coordination between central banks. I mean, what's the institution that would lead to coordination between central banks when, the European Central Bank is moving a lot slower or has been moving slower than the Fed? What's the institution that's going to tell the United States Fed to slow down its rate increases or the European Central Bank to increase its rate. So I think economists are sort of sitting around, it's a bit like a Mexican firing squad. They're all pointing guns at each other, I think, right now. So I don't think there's an easy answer to that question, but I understand the position that the Fed is taking on this.
Yeah, I guess I'm not as pessimistic as Ian is on this, and not just because I have bosses. I would say, you know, we definitely pay attention to sort of international trade effects and what it's doing to our inflation rate, what it's doing to our output growth. Likewise, why is Europe's rate increases slower? They have higher inflation, but they also are facing a more direct set of implications from the Ukraine invasion. So they have a different, you're always kind of trying to balance. And there is a lot of communication between central banks. They meet frequently in various G whatever meetings. In the Bank of International Settlements, there's a lot of things you don't coordinate officially to say, hey, we're going to do this, you need to do that. That sometimes happens, but mostly it's simultaneously looking at the same problems and figuring out what your version of the answer needs to be. And I'd say right now the US dollar appreciating is kind of what the world is needing. We need to pull down inflation. It will help, you know, many countries who export into the dollar markets. It will help exports for many places. It'll help support growth in places that are also experiencing shocks and slowing activity. So I'm not as pessimistic about, you know, our inability to coordinate.
Thank you. Well, I'm from Eastern Europe, and in the manner of a good dictator, Eastern European dictator, I'm going to evoke my privileges and ask the last question to Bill. Lots of our students are thinking, Intel, what kinds of jobs are they going to generate? We know about the technical job, but what about on the business side? What about supporting jobs on the business side and somewhat other related jobs to Intel and its supporting companies? What's your outlook?
There certainly will be some. There's going to be a role for financial analysts. There's going to be a role for production planning, management, a lot of management jobs. But what I want to say to y'all is I want to talk a little bit more high level. Yes, there will be Intel jobs. Yes, the economy is softening. Yes, the Columbus economic forecast is probably not going to be as cheerful as the last few have been. But the thing to remember is this. If job growth is slowing, if there's no growth in a particular industry that you're interested in, there are still openings because people retire, people get promoted, people die. And so you don't need 10,000 jobs. You only need one. And what I would suggest to y'all is that you should not be worried about taking a low-level, entry-level position that may not be paying you the $80,000, $90,000, $100,000 that you were hoping for. That's going to come. There is a very powerful force working to your benefit, and that is demographics. Mark showed earlier this trend of participation rates. That is the people in the labor force compared to the working age population. That hasn't come back. My guess is it won't, and here's why. We've been seeing since 2000 this downward trend in the labor force participation rate simply because people my age, not me, are retiring. And so there are lots of people retiring. If you break that participation rate and you look at it on the basis of age, pretty much everybody has come back, who is going to come back. I was talking about this trend. We had this big dip because of COVID. It's come back up, but it's come back to trend. And for the next 10, 15 years, we can expect a pretty tight labor market. I modeled a recession a few years ago just for fun. And what I found was that, especially in Central Ohio, it helped the tight labor market. It did not solve the tight labor market, and as soon as the recession ended, the tight labor market was just back. So for the next 10, 15 years, y'all are going to be in the catbird seat. So that would be, I think, my bit of optimism.
Well, I would like to thank all three of our participants. Thank you, Mark, for giving me advice to, if I want to get a raise, to quit first. So I'm going to have to call my boss about that one. Ian, thank you for relating barges not flowing on the Mississippi and sunflower seeds in the Ukraine and how they relate to inflation. Somewhat of a butterfly effect, I guess. And then, Bill, you know, every time I get that blue screen of death on my computer, I swear at Intel, like, oh, Intel. Now I'm going to see a traffic jam. It's going to be Intel.
Yeah.
All right, and thank you for reminding me that recessions are modeled for fun. Thank you, the audience, especially for your patience with us. With, you know, if this is not interesting, it's really boring, I guess. And, but hopefully it's not. And I will hope to see you here next year.
One last note, if you need to sign in to get credit for a class, make sure to do that at the table in the lobby.
I do not need to get credit for a class.
Why not?
Hooray!
Yeah, well, thank you. This was great.
This was a lot of fun. It was, yes.